Hey, welcome back investors. Sean with Learning to Take Money. We're going to be talking today about Markforged. We're going to do a little stock analysis, see what's been going on, and see if we can't get some market direction. Going to give you a couple tips in regards to the Williams percent R. We're going to learn what that is, what that means, and maybe talk about a couple other bullish signals that we've got. Stick around. This is going to be a good one. All right, let's jump right in. So here is the Webull app. If anybody's wondered what I'm using for my analysis and how I'm laying this out. We're going to talk about what we're looking at, how to draw some lines, maybe some Fibonacci's, and teach you guys a few things in regards to some of these indicators. See if we can't use them to figure out how to make some money. So first things first, if you look at this chart, what we're looking at is roughly from December early to current middle of February. You'll notice that in the last 3 days in particular, 4 days, we're having some really good uptrend. And if you look down here at the bottom of the chart, I'm using what's called the Williams percent R indicator. And that is a simple indicator that will teach you, or show you rather, good entries and good exits. Now, let me show you, before we get involved in all that, let's lay this sucker out with a little bit of direction. We're going to grab our favorite Fibonacci, click the bottom of the latest large move, and click the top of the move before it died. You'll notice what I did there, bottom of a large move to the top of a move before it passed. Now, what this is going to do is lay out some very simple lines for us and give us some expected lines and trend lines that we can use for resistance and support. You'll notice that here, when we came to this location, we had extremely good support. We had a double bottom. We ended up coming up and clearing through this channel. We were looking to bounce off of this line here for more run, but it didn't end up quite happening. A little bit weak, so we came back down, bounced and tested here instead. Had a muddy couple of days, and we finally ended up getting a good bounce off that support line. And you'll notice when you get a good quality bounce off that support line, you get really good volume and really good push to the north side. Now we got into the 164 territory, which we hadn't seen in quite some time, and we ended up losing steam there. Now there was a lot of bad news in the markets, a lot of different factors that took play on that, but ultimately we turned around. So when we broke through that top line, we came back down, we bounced off of this line again, and we had more momentum to the north side, but we just couldn't quite hold it. So we ended up tumbling down, got down to the next support line. And when we get down here, we're expecting a bounce, we're hoping. And when we get that bounce, we go back to the north side. Trouble is, this one took a couple days, ended up messing with a few people, definitely got a few people cut up in options. And if you're a short-term investor, it was probably a pretty rough run for you. However, we did ultimately bounce off of that line, and we got extremely good push to the north side. Now on the Webull chart here, you'll notice that we have these dots and squares. Now dots are bullish indicators, and if you drag your mouse over the top of the bullish indicator, it'll show you exactly what Webull is seeing and what Webull thinks is going on. You got a head and shoulders bottom right here, and you'll notice that when you get a head and shoulders bottom, you typically get a blowout. I mean, head and shoulders is one of the best indicators, the easiest indicators to recognize. All you're looking for is a head in the middle, like such, and shoulders, like here, and this very well could be forming a shoulder here. Now you're looking for a little bit more clear head and shoulders than that. You don't necessarily want to rely on what we're looking at here for a head and shoulders, but let's see if I can't line one out a little bit cleaner for you so you can understand the play. That's a great example. So what you have here is you have a head right here in the middle, a left shoulder, and a right shoulder. And when this happens, if it is in this direction, so shoulder, head, shoulder, this is a shoulder to the downside. Now clearly what happened after that rejection from that trend line was a massive dump in volume. You'll notice we had quite a few sellers as far as the volume indicator is concerned here, and that continued until we got down to this support line. Now notice what happened here. Lots of purchase right here. A lot of people trying to support that line with the expectancy of a volume up. Unfortunately, that did not pan out. So again, all we're trying to show you in this example is a shoulder, head, and a shoulder. Keep an eye on head and shoulders. They're an amazing play. They're easy to read, easy to understand, and they're typically a pretty damn good indicator of what's about to happen. Now what we're going to do here is we're going to get back to where we were, and let's go ahead and check out these trend lines. Again, we bounced off this trend line. We started heading north. When we came up here, we ended up retesting this trend line, which was a great thing. It came down, touched that line, faked out for a couple minutes there, not a big deal, more than likely a couple hours. And it finally started launching to the north. Now notice we got up to this trend line, we passed it, but we rejected. So we're at an extremely pivotal point right now with Markforged. What we're looking for to happen, we want to see this next candle open up. With any luck, in my opinion, it will drop to about the 134 point. When it gets to 134, if we get a good solid bounce, open a candle and go green, we're going to blow through that next trend line, in my opinion. Now, all we've been waiting for is the market to come back together and get more realistic and start heading in a bullish perspective. It's, to be honest, been kind of difficult with the CPI report lately being lackluster, depending on who you ask. But at the same time, this market currently, it seems like it's an opposite world. Any news that's bad tends to run the market, and any news that's good tends to kill it. I just can't quite understand that. And we've got the price crosses moving average. Now, if I select price crosses moving average, you'll notice here that the moving average has elevated, and this candle crossed the moving average, whereas before we were underneath it. Now, we did another price crosses moving average to the downside here, which wasn't good, but we recovered off of that trend line bounce. And now we are heading back above the moving average. Bullish indicator. But let's get back into this Williams. Let's talk about what is the Williams and how does it work. Well, here on Investopedia's page, we'll see that the Williams %R, also known as the Williams % range, is a type of momentum indicator that moves between 0 and negative 100. And measures overbought and oversold levels. Overbought meaning too many people have purchased it, you're at the top of a line, and you're expecting to go down. Overbought on the Williams R indicator shows you that you are about to go down. And if you look at the relation from here to here, it would have been a great entry for puts. Now when you get to the bottom of the Williams R and you get towards the negative 100, that's oversold. Too many people have sold it, and a lot of people are looking to buy it soon. So what that means is a good entry for calls, and you can pretty much count on a call run and have a good time if you're watching this indicator properly. Now notice that from the top to the bottom was this large move, but from the bottom to the top here was only half of that move. The Williams indicator isn't always directly connected point for point to the stock. It's simply showing you averages. Now, the indicator is very similar to the stochastic oscillator and is used in the same way. It was developed by Larry Williams, and it compares a stock's closing price to the high-low range over a specific period, and that's typically 14 days or 14 periods. So, using the Williams R is a simple way to try to find entries and exits for your plays. I wouldn't rely on it entirely. These are all just indicators. They're not guarantees, but if you utilize multiple indicators, you can get damn good direction and damn good ideas as to what you should be doing. So, getting back to the Weeble charts, let's go ahead and pop a couple lines in here. This is one thing I want you guys to start doing. I need you to start drawing your own lines and start learning your own techniques so that we can get you guys to start making some real money. Now, me personally, I like to use the extended line because I don't know when this is going to end, and I want to keep it on the chart without having to move it around constantly by using what they call here, let's see, the trend line is a dot-to-dot line. You'll notice if I place that, it will start and end where I decide. I can move it like this, or I can grab the circle, and I can adjust the angle and the length. I don't like that one so much because I have to move them so damn often. So what I do like is if you grab a hold of this guy, notice the end stays stuck. It's actually going to protrude throughout the map. It's going to go forever, so to speak. So you'll have a damn good indicator laid out for long range. So what you want to do, you want to grab this guy, and you want to set it up at the top of that candle. You need to move that dot to where we can reach it. Grab a hold of the circle, squeeze it together, drag it down. Now I can access both sides. Okay, so grab the circle, start at the top of this downtrend, a little bit too high there, and then grab this circle and go to the bottom of that trend line. Now note, this candle in the middle protruded past it, and that's okay. It's not always going to be a tip-to-tip line all the way down, and that's fine. I want you to grab a second line. Make sure you're on the extended again. We're going to go to the bottom of this candle, and we're going to go to the bottom of this trend. Click right there. Now, one thing you want to make sure of when you're drawing these trend lines is, number one, you want to make sure that they are almost parallel as you can get them by still staying in the rules. You don't want to fudge anything, but by all means, try to get them as parallel as possible. You don't want them collapsing in on each other like this. This is a different type of line indicator. This is what you would call a wedge. For all intents and purposes, today we're just looking for buying and selling channels. This here is a selling channel, a channel created because product is being sold. Why does this matter? Well, if you start up here and you follow this trend line, this candle blowing out of the selling channel was a beginning of a bullish indicator. Now, if this candle closed here and opened here, touched the top of the selling channel, and then took off north, that's a bullish sign. This can be shown down here. This candle opened above the selling channel, and it bounced off the selling channel, and bam, there you go. Further bared out by more indicators through the Fibonacci line we drew earlier. You can see there was slight resistance at the 134 point. We faked out for just a bit down to 131 and then rocketed through that sucker. Now you'll notice we hit that 153 and came across resistance again, which is showing that about 155, 165 range is extremely heavy right now, and it's going to be quite the fight to get through that. So hopefully some bullish news, maybe some, I'm not quite sure. Maybe some announcements from Markforged might get us through that. Very well could just be that the rest of the market takes off and this guy follows suit. Either way, we're in prime position for a good launch. But what we're looking for currently is to draw one more buying channel. And again, it's a buying channel because people are buying. So we're going to click at the bottom of this buying channel. We're going to go to that top line right there. We're going to create that line, and we're going to go ahead and make sure we finish the channel by secluding both sides of the buying channel. Now remember, we want to keep these lines somewhat parallel. You don't want them to collapse on each other if at all possible. Get them to touch the candle tip there. That'll work. Okay, so here's what we've got. When this candle closed above that selling channel and bounced, it created this new buying channel, and it's been respected here and here. Now notice we're in the middle, so we don't have any clear direction as to where we're going to go, but we do know that this is resistance and this is resistance. So ideally, this candle's going to open roughly here at the 145, 146 mark, and we're probably going to get a little resistance to the downside, resistance on the upside when we get to 153, 154. That's going to be the moment that matters. So we're going to need to keep an eye on 154 to the north, and if we clear it, likely take calls. If we get down to the 145, 146, and we blow through this, what you're going to want for a indicator verification is you're going to want to see another candle open, touch that line from the underside, and if that happens, we're heading back down. Now, it's the exact opposite of what happened here. It's very simple math. When you lay these lines out, it'll give you clear indicators and clear direction as to what possibly could happen, should happen, and is going on. It's a lot better than just investing on a whim, so to speak. So please, by all means, guys, get these lines drawn, start putting them on charts. Doesn't matter what you're investing in. Start following them, seeing if you can't utilize them to get some answers. Okay, so now that we've introduced you loosely to the Williams percent range, what we're going to want to look at is this chart in relation to the Williams percent. Now look up here. When we hit the top of this channel and we were turning around, clearly the Williams gave us the signal that this was about to go down. Now if you were to follow the Williams all the way through this, it brought you all the way to 86, what is this, 93 even. At 93, negative 93 mind you, this is a clear sign that we're going to be heading to the north side based off the Williams percent and how it was designed. Again, you could have taken calls here and you could have headed north. Now, you'll notice that when we get to this point, we're currently at 29.90. We're still out of the overbought channel. So in my opinion, we still have a bit of room to go. But I'm afraid that once we bounce off this line and head north, right about here is going to be the point where the Williams decides that we're overbought as well. That's going to be another point of resistance, something to keep in mind. I wouldn't play any long plays here, but I can definitely see some short options going on that might make you some money. Play safe. But let's see how respectful this Williams indicator can be. Down here, it was clearly oversold. Williams knew it was oversold and told us, hey, buy calls. And so if you did, you could have rode this sucker up to the overbought position. But this is where things get interesting. And this is why indicators aren't always a guarantee. You need to use multiple indicators. Notice how the Williams says it was overbought. This would have been a clear sign to take puts. Unfortunately, if you did, you'd have got chewed alive. You would have lost your money. Damn near guaranteed. It floated here in the overbought location for quite some time. We're talking damn near 2 weeks. That's very choppy play, very difficult to work with. But if you understand indicators, Williams being one of them, then you can utilize all of this information to your advantage. And you wouldn't have been caught in that type of chop. So when we get to the peak of this guy, we finally do start to see that the Williams gave up and started dropping. Now, it didn't drop very far, mind you. We only got down to a negative 69. But that was a play you could have taken. Now, to get out of that play, you would have had to utilize this Fibonacci indicator line as a point of downside resistance against the downside of this Williams percent range. This would have been a good time to cut the puts. Clearly, hindsight's 20/20. But it's just another reason why you don't want to rely solely on any indicator in particular. You need to utilize multiple indicators, not to mention market experience, to try to see where things are going. Now, if we're going to get into this sucker a little bit tighter, this is the daily. Let's go ahead and get into the last day in particular. And you'll notice that my lines here have been carried through, and you can see the trend lines in particular, how they've been respected. And it bounced off of this. We're above the moving average. This guy right here was a fake out from hell. Very well could have taken out quite a few folks if they were playing long options, and they would have tried to sell and get out of it. Unfortunately, it pulled straight back up, and they would have felt terrible for doing so. However, once you hit the top of this buying channel, that shows resistance back to the downside, and there you go. Now tomorrow, the reason I suspect that this is going to go to the low side of the buying channel is because of the clear indications that we have here. If this guy hits this channel line and goes north, we've got room to go to 153, 154. But we do need to blow through this resistance line. And it's also a line that's shown resistance in the past. About here, let's see, right there. You see there's quite a bit of chop right there. A little bit of a blowout over the top, but not much. So it's some place to be careful, definitely. You don't want to take too much risk. But what we're looking for the long term, if this guy clears over the top of 153, what we want to see is we want to see this next candle open, touch the top of 153, and if we get a candle bounce that goes north, you can take some calls. That's a damn good sign. It's a damn good indicator. I can't stress this enough. Not any indicator solely is a good indicator, but all indicators can be good when used in unison. So my long-term view on this, what I'm expecting currently is that we're going to come back down to the 134 trend line. That's just where I'm at. We've got a lot more support right there that we've been building at 134. So I expect to see us hit this trend line and bounce back north, but it really depends on market news. It really depends on momentum. I'm hoping we get some news out of Markforged. Hopefully some new announcements, new products, something like that. Maybe even a partnership. And keep in mind, there's been whispers about an acquisition. So something to watch for. Either way, here's where I'm at. We're looking at a low side of 134 in the next few days. We're looking at a high side of 160 in the next few days. If you're going above the 154 mark, look for calls, but wait for confirmation off of that line. Now, confirmation is going to look somewhat like this. We'll go to the north. We're going to come back down, bounce off this trend line, and if we do, we've got room to go. If we don't, we're going to go to the north, bounce off the bottom of this trend line. If we open another candle and it shows weakness, we're heading down. What we're looking for is a bounce off of the 134 trend line, and Lord only knows what's going to happen after that. We'll have to reevaluate. So 134 on the low side, look for a bounce. If you do get a bounce on 134, take calls. Looking for 153 to 155 on the high side. If we can get a bounce from 155 to 153 and north, then we're doing great. We're going to go ahead and break this channel. I'm pretty confident. Now, last thing here, guys, again, just evaluate charts in multiple ways. I don't want you to just look at them in the 1 minute. I want you to look at them on the daily. 1 minute, go to the 5 minute, let's go to the 1 hour. Let's draw lines on all those charts and let's get some indications as to what possibly could happen. It's really simple. Just take a few minutes, evaluate the charts, act like you know what you're doing, and eventually you will. Now that's about it for today on Markforged. I'll be doing another update on this in the middle to end of next week. We'll see what we ended up with, and hopefully we ended up in this range up here so we can talk about the next leg up. So that's about it for today. Thanks for watching, guys. Again, I'm Sean, and this is Learning to Take Money, and we'll see you next time.